Investing can feel like learning a whole new language, especially when financial experts start throwing around terms like diversification, asset allocation, or risk tolerance, as if everyone knows exactly what they're talking about. But let's be honest, a lot of people nod along without fully understanding how these concepts actually apply to their very own money. They can be a bit of a problem. Now, whether you're just starting out to invest or managing a growing portfolio, understanding these core principles is what separates confident investors from those who are flying blind. Joining us to make sense of it all is Brendan Caldwell, Director of Caldwell Securities Limited. Brendan, welcome to the show.
Hal, great to be here. Wonderful to talk to you.
You as well. So, Brendan, what does diversification actually mean, and how do you know if you're really diversified?
Well, let's start with your introductory comment. I think all professions use buzzwords, jargon, terminology to make themselves appear smarter than what they actually are. Now, if you're a doctor or a lawyer, an accountant, you may actually be quite smart. But the investment business could be all over the place. So we like to use buzz terms just to sort of make us feel that we have a leg up, have a certain superiority. So take a term like diversification. I mean, if you want to dial it back to the Aesop's fable, it's not having all your eggs in one basket.
Right.
And being diversified or otherwise may or may not be the right approach for you. Having one basket with all your eggs in it and watching that basket very closely is how people who became very, very rich tended to do it. They focused on one thing. But that's one thing that they usually had a hand in the outcome. To the extent that you're owning investments that are passive, where you're not actively managing the company or the property or the other whatever the asset is, to the extent that either other people are looking after it or that it sort of looks after itself. Having diversification is having assets that don't always do the same thing at the same time. So that, and if they aren't vulnerable to the same stresses. Now, some people may be diversified by saying that, well, I have all my money in I have money in real estate, and then I have money in the stock market, but the stock market investments, say, are in real estate investment trusts, and their living is as a real estate agent. I mean, that sort of thing would be the opposite of diversification. That would be heavy concentration. Now, if real estate does well, you may do extremely well not being diversified. But for most people, most of the time, that want to actually do what they do and have other people look after their money, having money in investments that don't work the same way at the same time, which would include real estate, the stock market, something in investments that are guaranteed, that aren't all going up or, more importantly, not all going down together. Being diversified means something like that. Having investments that perform in different ways at different times, so that overall your wealth doesn't take big dips, big ups and downs, but grows hopefully a little more smoothly.
You know, I wish I would have invested in real estate in Toronto and Vancouver 20, 30 years ago. That would have been something. So, Brendan, let me ask you something. What is asset allocation, and why does it matter more than picking stocks?
Well, let's take your analogy about real estate. I mean, Calgary has been a wonderful place to invest at certain times. I think that's where you're based, yeah?
Yeah, that's right.
Um, so, but yeah, Vancouver and Toronto have done extraordinarily well for the last while and maybe continue to do so. But if you're looking about real estate, not all regions are going to do well at the same time. But real estate as a whole tends to work very much together. I mean, particularly on the downside, we saw that in the 2008 financial crisis. Canada did not get hit nearly as badly as the United States, but real estate all over the world took a bit of a hit, which is why having all one's money in real estate, probably not the best way to do it. Having some money in real estate, which can be very good for the long term, but if you need money quickly, very hard to get at it. The stock market tends to do something different than real estate for various reasons. It tends to actually go up and go down, and then the real estate market tends to follow suit. And then there's really another couple of asset classes which have emerged for investors in in the recent times. One is private equity, that is money invested in businesses that aren't publicly listed on the stock market. Now, people are in private equity in as much as they own their own business, but having investments in businesses that maybe are in different industries, particularly in technology, there have been a number of great success stories, but having diversification, to use our earlier buzzword, in and around the private equity sphere, in the private equity asset class, means that you can participate in some of the good ideas that maybe one doesn't have an active part in the business in. So private equity, real estate, stocks, fixed income, that is bonds, GICs, they had been a worthwhile asset class for a long period of time, but it's very difficult to convince people that it's an exciting place to have one's money at 4 or 5%, and interest rates are even a little bit less than that now. So the last one is, I guess, crypto, which is a tough one to know what to do with, because it's done so very well since the late 2000s to this point, gone from a few $100s a Bitcoin to what, $120,000 today. So, but that is another asset, and all of these different asset classes tend to work differently. So it's having different asset classes that work differently is a good way of getting diversification, to link our two buzzwords together.
So, Brendan, what does risk tolerance actually mean? And how does it differ from risk capacity?
Okay. Well, I would say risk tolerance differs from person to person. And this is why I think it's very important to have a good investment advisor. That's probably the most important investment decision, or someone that you can at least talk through and hear yourself out loud talk about what risk really means to you. Because in the investment business, just like there are buzzwords, there are mathematical models, again, to make us appear smarter than what we are. Call it mean variance or standard deviation or other more esoteric measures of risk, the Sortino ratio, whatever that is. So there are ways that we can measure risk, but that's not the same for a real person as, what are the chances I'm going to lose my money and never get it back again? I mean, that might be people's bottom line risk tolerance. And even if that's not a likely outcome, if the fear of that happening causes them to pull money out at exactly the worst times, then they're probably exceeded their risk tolerance. I would say risk capacity is how much money can you invest, and if it doesn't work out, that it really affect your ability to exist day to day or in the future. So I don't think you want to make too many investments that affect your risk, that would negatively affect your ability to live. And some people get the bug. They borrow money to invest, which automatically, literally leverages up your risk, because time, which is normally the friend of the investor, is your friend if you're investing with your own money, but it becomes your enemy if you're investing with borrowed money, because every single day interest rates are working against you. The effect of compounding, and also the stress factor, because if the markets go down, you're losing your money first and only the lender's money later. So I think that a risk capacity, what are the chances, or what is the ability of this investment to really impact my lifestyle? And risk tolerance, I think, is more, what can I live with? And that's best discussed with someone who's had that conversation, is able to ask the right questions.
Now, we only have a couple of minutes left here, but I wanted to ask you, what does it really mean when someone says the market is efficient? And does that mean that stock picking is pointless?
I think that's probably what they mean. And I don't know that it was ever true, because to the extent that one knows more about a stock, be it a private company or a public company, than the world in general. And I don't mean insider information. I mean really knows, like a young person a few years back that knew about Roblox, or that knows today about AI, or is following a particular fashion, like Aritzia or Sephora. My kids have bought those. Sephora is owned by LVMH, the big French multinational. So if you know more about a company or a product than the rest of the world, then I think stock picking makes a great deal of sense, because you're investing what you know. Now, the idea of the efficient market hypothesis is that it doesn't matter what what stocks you pick, because if you buy the market, you're getting the benefit of a million people making a million individual decisions, millions and millions of investors making millions of individual decisions. The funny thing is, right now, with more and more people going to index investing, passive investing, buying the market, it means you've got not millions of people making millions of individual decisions, but millions of people making but a single decision, that is to buy the index, to buy the market. So I think actually there's more opportunities now in individual stock picking than there may have ever been in a long time, because invariably when everybody's doing one thing, the opportunity is usually elsewhere.
Brendan Caldwell with Caldwell Securities Limited. Thanks so much for your time today.
Thank you, Hal.
Coming up, we'll have more of today's national and international headlines. Stay with us.